exchanges are the best, as far as I'm concerned, business model around at the moment. And I mean, you look at it, they're the epicenter of e-commerce. I mean, all these things like Airbnb, Uber, etc. What are they but exchanges? And it's a great business, and it isn't great business as well for inflation. We're going to come back to inflation in just a minute, though. So you've built this ETF. Now, hold on a second. Let's take that back a few steps. How do you manage to come to the idea one morning and just go, let's make an ETF, let alone what that ETF is going to be? Alan.
So, interestingly enough, the firm has been concerned with inflation and actually debasement of currency for the last 4 or 5 years, actually, even prior to COVID. And that idea has been displayed in many of the names that we've invested in over the last several years and written research on. And when COVID happened, we as a group sat around and said, hey, this is sort of a time where there might be potentially more inflation than we had even expected and had been thinking about for the last few years. And you add on $5 trillion in stimulus, and we realized there's going to be a real situation here. And when the team sat down, we said, look, we have a lot of names that we've followed and invested in for many years, but we don't really have any products that really can directly address an inflationary period. When we looked out into the landscape, we said, well, what exists out there for investors to invest in if there is inflation? And the typical things come to mind, either tips or tips-based portfolios, base metals, or energy. And so that's sort of what's been existing in the marketplace if you want to address inflation. The issue with those is that, first of all, each of those topics are binary bets on inflation. In order to get inflation and address it with those type of investments, you really have to have inflation. Actually, tips, which we've seen a lot of inflows in over the last year or so, has not performed that well at all based on the shape of the yield curve and where we are in the interest rate environment. So we want to come up with a portfolio that would enable investors to directly benefit from inflation, but not be a binary bet. And so we sat around and said, how do we do this? And so the team spent a bunch of time looking at what was available in the marketplace and sort of came up with Inflation Beneficiaries ETF INFL.
Taking a step back while you're still working your way through building this ETF, you got tips, you got things that are based on CPI and so on. But of course, in America, you've got two massive degrees of inflation. You've got a CPI number, you've got a PPI number. Most of the rest of the world have something similar. How do those measure up? And in fact, what's the best one to actually be trying to look at?
Yeah, that's a great question. And I think that one of the issues with TIPS, so Treasury Inflation Protected Securities, is that the government offers to protect your principal and your coupon with CPI. And again, I talked about how people don't really understand exchanges. A lot of people in this industry don't know that TIPS were actually only created in the late 1990s by Larry Summers, supposedly for Ray Dalio, so he could put it in his all-weather portfolio. But basically what it is you're discounting multiple things. One is the absolute level of the 10-year bond relative to inflation expectations. So there's a lot of ways to lose here, one of which is if CPI doesn't properly capture what's really happening with inflation. And so to your point, what's the right measure? CPI, PPI, the PCE deflator, there's all these numbers that are out there. But I'll just give you one quick anecdote or two. They just released the December number here in the United States for CPI, which is produced by the United States Bureau of Labor Services, the BLS. There's an addendum at the bottom which says there were 70 adjustments due to anomalous behavior and pricing over the last 12 months. So you might take pause and say, hey, maybe inflation is higher, maybe it's lower. If you're adjusting 70 variables, what was the actual experience? But the other thing in CPI that I think is really extraordinary is that they don't take the actual home price or rental prices. The number one measure in about 33% of the composite is shelter. The biggest component of that is what they call owner's equivalent rent. So instead of the Case-Shiller index, which was up north of 15, 18, maybe 20% last year, the owner's equivalent rent figure, I believe, was around 4%. So that's 1,600 basis points of spread for your shelter, which is a very huge portion of many Americans, especially those in gateway cities, a cost of living expense. And that was understated by a factor of 4. So again, you need to really look at what the data is representing and what is it supposed to capture versus what do you think it captures.
So if we're looking at this whole concept of inflation, I've got to ask you, gentlemen, give me a rough idea. Where do you think, or how bad do you think this particular inflation crisis is going to get? Not necessarily a number on inflation, although that's welcome, but how long is it going to take to get the inflation genie back in the bottle?
I'll give a brief comment, then James probably will give a better answer. One of the things that you're not going to be able to stuff back in the bottle is wage inflation. A lot of companies have had trouble hiring people, and they've had to pay premiums to where they were previously paying them. It's very hard after this time to go back and say, hey, never mind, we were paying you $20 an hour. Now we're going back to $15. That's not going away. There's a lot of other things that will occur as well, but that's one of the things that's going to be very hard to change.
I'll touch on some dangerous territory here, but say that it's going to come down to the will of politicians. And this isn't specific to the United States or the EU or the UK or any government thereabouts, but policymakers at a certain point are going to have to choose. Am I going to prioritize employment, ergo economic growth, or prices? And you're going to get thrown out of office a lot faster with a recession than inflation. Plus, you also have this debt burden where in all these developed countries, the easiest way to pay down your debt, you either default, you grow out of it, or you inflate. And obviously, let's hope for the moment that any type of default is hard off the table. The limits to growth, productivity times labor force, probably we can't grow out of this. So the only other way out long term is a debasement of these currencies. And so looking at the incentives of politicians, long term, I think this is going to be with us for a generation. So the days of 2% are gone. Days of above 2% are probably going to be here for a really, really long time. It's just a question of, does it really run away from itself? And one more really important thing is that the trend is more important than any given episodic time series. And what I mean by that is December, year over year, you're at 7.5. In 6 months' time, you might be year over year at 4 or 3 or 5. But the trend is upwards, and the trend is far higher than pre-trend. And so that's going to have a lot of implications for businesses' margins, for interest rates, and for how to approach markets. And I think that that's the important thing. This is a secular shift. The same way that when Paul Volcker came in the 1980s and said, I'm breaking inflation, I think we're kind of going in the reverse now because of all those factors that I just mentioned.